Bloomberg Audio Studios. Podcasts, radio, news.
You have all of these flip-flops within the volatility and the price action of markets.
I think it's more likely that we revisit the lows than we don't.
It turns out that's the beginning of the volatility in bonds, not the end. So the next 90 days is going to be quite volatile in the bond market.
What's happened generally lowering the risk in the portfolio in this type of environment, rather than a strong bet on you want to be in bonds and equities, you want to bring risks down.
What we're looking for is a very choppy year, unfortunately.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Anne-Marie Hordern.
Live from New York City this evening. Good evening for our audience worldwide. Bloomberg Surveillance starts right now. Wrapping up a wild week in financial markets, investors getting their hopes up following the biggest weekly gain of the year so far. The White House unveiling what appeared to be tariff exemptions for big tech, only for Commerce Secretary Howard Lutnick to rain on their parade.
They're exempt from the reciprocal tariffs, but they're included in the semiconductor tariffs, which are coming in probably a month or two.
President Trump doubling down, writing there was no tariff exception, announced on Friday. They're just moving to a different tariff bucket. So we enter a brand new trading week with a very brief sigh of relief.
Is this a sigh of relief? Do we have a sense of what the tariff is? We moved from one bucket of 146% to maybe 20%, which is the fentanyl bucket, which is where electronics fit in. Look, this seems like President Trump coming out and trying to push back against the idea that he pivoted while still offering some support to the idea of electronics. It is clear, based on what Jamieson Greer as well as Howard Lutnick said, that they are looking to move forward with an additional framework of tariffs for semiconductors.
Are we negotiating with China or negotiating with ourselves? And after a week like the one we just saw, a 6% rally almost on the S&P 500, is this a policy pivot or not from this administration?
What was the policy? I think that is the bigger question right now, and there is a level of exhaustion. Is this the ultimate goal? Is this all according to plan? Because that's what a lot of people were saying. Right now, people are exhausted. People on Wall Street are exhausted. The uncertainty itself is going to drag on growth, and that is what you see in notes pretty much across the board. Did we get clarity? Yes. We got one note of clarity, and that is that this is a president who is watching the Treasury market, but the sort of input there is still unclear.
The first trade this morning in the equity market, this evening rather, positive by 0.9% on the S&P 500. Coming up this hour, Bob Michael at JPMorgan as bond market moves spook investors worldwide. Libby Cantrill of PIMCO as this weekend's policy confusion continues. And Stuart, Kaiser of Citi on why we need good news and we need it quick. We begin this hour with our top story this weekend. Apple and Nvidia appearing to score a major win, only for the White House to rain on their parade. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, you need to explain just what happened this weekend.
Yeah, hey, John, good evening. Well, it's unclear how long this reprieve will last because it does appear that these tech imports will be subject to a Section 232 investigation, which could take weeks or even months. We have to keep in mind that when President Trump signed that initial executive order on April 2nd, it always excluded chips, as well as some other key industries like lumber, pharmaceuticals, and copper that could be subject to Section 232 tariffs on the basis of national security concerns. It now appears that these other tech imports, including consumer electronics, will fall under the sector-specific umbrella instead of the so-called reciprocal plan umbrella. As you said, President Trump just saying that this moved from one bucket to another. Now, with that said, when this White House has invoked Section 232 before, including on steel and aluminum imports, auto imports, they've implemented a 25% tariff rate. Let's just say, for the sake of the example, that ends up what goes into effect. That would be considered to be at least an initial victory for big tech, because that is so much lower than what could have been the now 145% tariff in across the board when it comes to Chinese imports. But still, some really big questions here, not just on the timeline uncertainty, but also how is the White House going to look at the full scope of these electronics? For example, are they going to tariff the value of an iPhone on its whole, or are they going to tariff just the value of the chip inside of the iPhone? Questions like this are going to keep coming up. But John, I will just quickly add, the one thing that remains the through line here is that President Trump doubled down in his post that this really is about China reiterating that all of these products are still subject to that 20% baseline tariff that Washington imposed back in February.
Tyler Kendall with the latest down in Washington, D.C. Tyler, thank you. Stay close, as always. You were looking for that first trade this evening, this Sunday evening equity futures. Here it is, positive by 1 full percentage point. With more, here's Danny Berger. Hey, Danny.
And more than that, when it comes to tech, John, you're looking at a NASDAQ 100 future session that's up 1 1/3%. Maybe it is buy now, ask questions later. They're signaling the fact we are trading this as something of a relief rally. So 1% for the S&P, just under 1 1/3 for the NASDAQ. Your small cap session so far with trading just underway, 0.7%. Calling this a relief, though, might be a misnomer because we have seen some huge swings. What is 1% when we've seen stocks up and down 10% on some days? So let me just show you where we came from to get to this future session. The past 5 trading days was the best week for the S&P 500 since November of 2023. Why did it not feel like that? It's because of this volatility that we've seen. In fact, in the 5 days through Thursday, we saw a trading range of more than 6%. That streak has only happened 2 other times in history. One was March 2020, the COVID epidemic, and then the other one was October of 2008, the peak of the financial crisis. John, I think a lot of traders are going to be relieved that we're heading into a holiday-shortened trading week coming up.
Danny, we can't wait. Danny Berger, thank you. More from Danny later on this hour. Wild swings in the equity market. Wild swings in the bond market too. Here's the big take on Wall Street this evening. Bob Michael of JPMorgan Asset Management writing the following. Over the last couple of weeks, investors have been searching for signs for anything that broke. At the end of this week, the most unlikely of candidates surfaced. The US Treasury market. The global head of fixed income joins us now for more. Bob, good evening. It's good to see you.
Yeah, happy to be here.
2 Sundays in a row. Let's wrap up this week. The move we saw this week in the bond market, yields up by 40 to 50 basis points on a 10-year and 30-year maturity. The dollar down by close to 3%. Everyone's got the same question. Evidence of bond trades blowing up, or are you starting to see people distance themselves from dollar assets?
I think that's a great question. From our perspective, we're seeing a complete deleveraging of positions. And that's what's been driving it. So whether it's been swap spread trades, whether it's been the Treasury basis, whether it's been investors who sold Germany and bought the U.S., all those things have begun to unwind, and it's put a lot of downward pressure on Treasury prices. 2 things happened at the end of the last week that make me feel a lot more positive this week than going into last week. The first is Susan Collins came out and broke from the Fed's grip of the only thing we're watching is inflation, and talked about we'll be prepared, we're watching the market, if we need to step in, we'll step in. The other thing that we saw was the Fed report that showed that actually foreign central banks and reserve managers weren't selling treasuries, as was widely rumored. They actually even added a little bit. And in our conversations with overseas investors, they're not being shaken out of treasuries.
If that's the case, then how concerning would it be to you if treasuries didn't rally this week?
I think there's still a bit more of a washout to go. I think there are still the investors that are coming in overseas that have seen the downward price moves and may be unwinding some positions. But I feel pretty good that we're putting in a low in price and a high in yield here.
So this is the ultimate question right now. Can this be a haven asset at a time where the dollar didn't get that bid and the Treasury didn't get that bid? Going forward, how much has to happen for the Fed to come back into play, given the fact that Neel Kashkari over the weekend came out and said, ultimately, where the yield ends up isn't going to really be a determinant of the Fed. It's going to be about these policies when people can understand what the new normal really is.
Yeah, and I think he also threw in inflation being anchored. It's funny to me how the entire FOMC, and we'll see more this week, are coming out and just highlighting inflation when a month ago, their chair, Jay Powell, discredited it at the press conference and called it transitory again. He's going to be right this time that it is transitory. It's a one-time price reset for tariffs that will create demand destruction and lead us to recession. And when I read Bruce Kasman and Mike Ferroli's stuff, they still have the probability of recession still up at 60%. The Fed is watching 2 things. They're looking for signs that something systemically broke, and that becomes a bigger problem. Right now, we're not seeing that. eerily feels like an orderly unwind. I think that's good news. The other thing they've got to be watching is the other side of their mandate, which is the unemployment rate. We think if you get up 4.7% or higher, that's up 0.5% from here, then that will put the pressure on them to come in and bring rates down. Remember, they told us this isn't the neutral rate. This is moderately restrictive. 3% is neutral.
The next meeting, May 7th. Last time you sat there, just last week, you doubted whether they could hold on until May 7th. What's your view on things now? Can they hold on until May 7th? And do you think May 7th is the day they pull the trigger?
Yeah, last week it looked like we were in meltdown phase unless there was a policy response. I think we've seen 3 soft policy responses. The first came from the administration. You already went through. They gave us a 90-day reprieve. That's fine, and they took some of the tariffs off of electronics for the time being. That's okay. That's backing up. The second came from Congress, where the House passed the Senate budget resolution. So Congress, in a way, gave us something. And then I'm going to say the third is Susan Collins finally sending us home over the weekend saying, yeah, the Fed's watching this. We got this.
Lisa, we went into the weekend with some pretty dreadful data. UMich consumer confidence came out, sentiment near a 3-year low, inflation expectations, multi-decade highs, anxiety about unemployment, the worst since 2009. And I think we sit here this evening going into a new trading week thinking about the next phase of all this, the damage that's done already and what it looks like in the economic data in the weeks to come.
That's really the main message. You can't put the toothpaste back in the tube. You can't put the genie back in the bottle. We have seen a change. We've talked about uncertainty, but there is some certainty that things are less good than they were earlier this year, and that this is going to have ramifications for spending and certainly among corporations.
Bob, just finally for this part of the conversation with you this hour, can you undo the damage that's already done? Are you anticipating a round about of pretty weak data in the weeks to come?
Yeah, I think so. And again, as I was reading Ferroli and Kasman's pieces over the weekend, it's really hard to change the confidence of businesses and households. And hence, that probability of recession is still up there at 60%. It's not 100% because you can see an overwhelming policy response. How many times have we been here during COVID or during the regional banking crisis when for sure we were barreling into recession, but the aggregate policy response was sufficient to stop it? We may see that this time, but for now, we're on path to recession.
This time, to get that response, you need to see the data break, Lisa, and that jobs report for this month that you'll see in early May. I think a lot of people are going to put a lot of weight on that particular print.
But how quickly can you get some sort of layoff wave, given the fact that so many companies are still scarred from the experience during the pandemic? And we've seen this in note after note. It is going to lag behind, and that is a complication for the Federal Reserve.
The difference between laying off and just not hiring. And given how many times we've heard people say, wait and see, you'd have to imagine for a lot of people, they're just going to pause hiring, aren't they, for the next few weeks, next few months?
Which is the reason why watch the quits rate. Watch how many people stay on the unemployment claims for longer as that number goes up. These are some of the peripheral data points that people are watching.
If you're just joining us, welcome to the program. Good afternoon to you. Equity futures trading, and we are positive by 0.9%. Bob Michael at JPMorgan will be sticking with us. Up next on the program, the White House keeping the pressure on.
What President Trump is doing in his vision and his leadership is to completely realign the world economy, but in so doing, put America first.
The president is on it.
Up next on the program, we'll get the view of Libby Cantrill of PIMCO, live from New York City this evening. Good evening. The first trade's underway. Equity futures at the moment positive by 0.8% on the S&P 500. On the Nasdaq, up by 1.3. Under surveillance this evening, the White House attempted to keep the pressure on.
The president is on it.
It's very, very important for people to understand, why we're doing what we're doing.
What President Trump is doing in his vision and his leadership is to completely realign the world economy, but in so doing, put America first.
The world cheats us. They've been cheating us for decades.
We have been living under a tariff regime, but it has been the regime of other countries.
But more importantly, they cheat us with the so-called non-tariff barriers. It's the VAT taxes, the dumping, the currency manipulation.
We can't be relying on China for fundamental things that we need.
It's going to be up to these countries to come to the table, continue coming to the table, and make these kinds of offers.
So here's the latest this evening. The White House pushing for change. The president writing, nobody is getting off the hook. We will not be held hostage by other countries. Lisa, especially hostile trading nations like China.
There was no tariff exception announced on Friday. These products are subject to the existing 20% fentanyl tariffs, and they are just moved to a different tariff bucket. So we need to understand the tariff buckets, and the 20% tariff bucket does apply to what we're seeing in China. Got that good. Is it now 30% if you've got a 10% base that comes out? Is it going to be added to the 146? You know, you can explain that.
Just what is the number? Paul Ashworth of Capital Economics had a go at this and said the increase in the headline tariff rate on China specifically remains at 145%. But the effective increase, once those exemptions are accounted for, is now closer to 106. You got that?
Clear as mud. I mean, look, this is the difficulty for so many people, is that the layers of tariffs just become incredibly difficult to even start to calculate, to the point where people start to discount them entirely. Amazon had a note where they came out and said, if we calculated this correctly, the numbers would be so ridiculous that we couldn't even come out with those estimates, which is what we're hearing pretty much across corporate America.
Let's get to the take from Libby Cantrill of PIMCO, writing the following. We should not underestimate Trump's ideological commitment to this issue. So while the worst may have been avoided, trade policy uncertainty should be priced in going forward. I'm pleased to say that Libby joins us now for more. Libby, good evening. We go again.
Here we go again.
It's good to see you. Look,
nice to see you.
After last Sunday, a lot of people started to believe there was a policy pivot, a 90-day pause, and into the weekend, some exemptions. Then we got the pushback over the weekend. Has there been a pivot or not, from your perspective?
Yeah, I don't think there's necessarily been a pivot. Maybe some practicality has sort of trumped the ideology, if you will. However, I think a couple of important points. One is that this Section 232 investigation on semiconductors, that was previewed at the beginning of this administration. They are very committed to this. Ambassador Greer reiterated this in front of Senate Finance and Ways and Means this week. So this is coming. However, and I think your earlier segment sort of alluded to this, it will likely be a much lower tariff schedule for semiconductors, potentially for phones, potentially for consumer technological products. And so that means you're going from 145% tariff maybe down to a 25% product tariff plus those 20% fentanyl. That's 45%. These are still incredibly draconian, right? If you had mentioned any of these types of tariff levels at the beginning of the Trump administration, I think the market would have obviously had some indigestion. The second thing, though, I think really importantly, is that the actions over the weekend, I believe, make this IEEPA authority, this emergency economics powers authority that the president is using, more vulnerable to legal challenge. Because he is using this with the declaration that this is a national emergency. Well, is it or not, right? If you're actually carving out exemptions, a sort of Swiss cheese approach that Ambassador Greer actually had said about 2 weeks ago, if you're doing that, then it kind of undermines the entire basis for IEEPA. So in some ways, I think actually the real story is that this is already a legally vulnerable, kind of maybe specious use of IEEPA authority, probably is more vulnerable given the actions of the weekend.
Okay, hold on. This is actually fascinating to me. Who would then sue President Trump? And how long would it take for this to be undermined in a court of law, and would it be followed?
Yeah, so a couple of things. One is that there is already litigation in process. There are some trade associations that have already filed kind of the first steps towards litigation in terms of questioning this use of IEEPA. But to your question, and this is obviously very pertinent to markets, this will take a while to go through the judiciary. There's not likely to be an injunction because you'd have to see irreparable harm, and I think that threshold is very, very high. I'm no lawyer, but I'm just saying.
You play a good one on TV.
From what our trade attorneys are telling us, it is that the threshold is high. However, this is, and again, I think a lot of trade lawyers, those who are actually attorneys, would say that this was already a very aggressive use of this statute. And again, I think today's or this weekend's actions make this more vulnerable.
A lot of traders would become lawyers overnight. You know that. Bob Michael might become one too. Bob, how would this market respond to legal challenges in the weeks to come?
It wouldn't like it because that's more volatility, that's more uncertainty, that's more confusion.
You think it's market negative?
I do think it's negative. I think that at this point, the markets would like to see some sort of agreement on where tariffs are going to settle, be able to model them and move on. The other thing I wonder when I listen to Libby, we're talking about Trump having an ideological view about rebalancing trade. I also think he likes the revenue now. When you listen to him, whatever they're modeling on tariffs, he doesn't want to give that up. And I wonder how sustainable that actually is.
So this raises a question, Libby, about what exactly was the point of putting out the tariffs as they did if they were going to carve out exemptions a couple days later, and whether this was planned. You always start your letters, I'm going to just sort of give you your cheat sheet, is what is going on, and then you list things that are going on. You don't have to actually list anything. You just say what is going on and send it out at this point. But can you have a sense of what exactly led to the shift and the exemptions being announced, or was this already planned? Do you have any insight?
So I think that this is, I mean, I think this, the White House will say this, that President Trump is his own economic advisor. From our understanding, there were several sort of avenues which he could have explored or he could have pursued on Liberation Day. He picked arguably the most draconian, the most sort of ideological, the most extreme, and I think, again, sort of the most legally specious. But there were other avenues that he could have pursued, and I think that maybe we're kind of going to one of those other channels, maybe a more moderated. Now, of course, I mean, what our economists have said is, and what Bob had said earlier, I mean, this is still, regardless of these, even if these exemptions hold, this is still an incredibly high effective tariff rate. I mean, we were looking at an effective tariff rate in like a 20% potentially on all imports. Now, if imports collapse from China, that effective tariff rate goes down, but there's obviously a lot of friction from an economic perspective, and that does increase recession risk. So we're definitely not out of the woods yet. I do think, actually, I think a legal challenge would probably be welcomed by the market. I mean, I think they would really like that. However, and I think this is maybe to Bob's point, is that the president has a lot of unilateral authority around tariffs. So if it's not IEEPA, then it's Section 122. If it's not, it's not necessarily, it's Section 338 of the 1930 Tariff Act. The point stands is that Congress has basically delegated a lot of authority to the White House, and he can do a lot without Congress here.
There were a lot of people after the weekend looking forward to going into the trading week to get a limit long Apple after the announcements over the weekend, get a limit long, say, Nvidia. Can we just sit on sectorial tariffs now?
Yeah.
What's the base case? Is there one?
Yeah,
How big will they be?
So I would say, our base case is a 10% baseline tariff is here to stay. And to Bob's point, they like the revenue associated with that. That also sort of fits with the ideology. So 10% universal tariff. And then these sector tariffs on semis, on pharma that are forthcoming, on autos, on steel and aluminum, and then a higher tariff rate on China. I think the big question is, like, how high is that? I think my view is it probably doesn't stay at 145%. Does it go down to 30, 40, 50%? Obviously, this is all speculation. But some sort of mix of that is our base case. Again, that is a really high effective tariff rate that will have real economic and inflationary outcomes. But again, less draconian than what we've seen over the last 2 weeks.
Bob, you said that markets wouldn't like uncertainty. And if there was some sort of legal challenge, it would just prolong the uncertainty. Are you talking about bond markets too, given the fact that you still think that they have their haven status?
2 words, Doge, Elon, right? That's where we last had the legal challenges. Where did that get you? What's happened there? Nothing.
Well, okay, but with respect to the bond market as enjoying this uncertainty, if it's accompanied with some slowdown in growth, if it still can act as a haven?
Absolutely. I do think the bond market, the U.S. Treasury market is a haven. The bond market is a haven. I think legal challenges will actually push people into the bond market. I think we're finishing that washout process. It may continue into the start of this week, but I think everything that needed to delever has largely run through that process. I think the bond market's in a pretty good spot.
Big week coming up for fixed income. Bob, thank you, sir. You're going to stick with us. A special thanks to Libby Cantrill of PIMCO. Libby, thank you.
Thank you.
If you are just joining us, welcome to the programme. Equity futures right now just about positive. The first few trades of the following week, the brand new trading week, are on, and we're positive by 0.5%. In just a moment, we'll catch up with Stuart, Kaiser of Citi on what he calls the least enjoyable 5% rally in recent memory. Live from New York, this is Bloomberg. 30 minutes into the trading week, your equity market looks like this. We're positive just about by 0.4%. Maybe not the gains you were anticipating after the headlines around exemptions over the weekend. The Nasdaq up by 0.8%. With more, let's cross over to Danny Berger. Hey, Danny.
It may be a market that's trying to trade off headlines, John, but this could change as we enter the week. We're about to get into the thick of the earnings season. Julian Emanuel is saying what I think a lot of people have said, the results themselves don't matter. It is the guidance and how they're navigating tariffs. We've already had a bit of a hint of that over the past week of the earnings we've heard from so far. The general consensus we've gotten is it seems like every company is handling this in a different way. Walmart's saying we can't raise our prices. Value is important for our customer. We're going to take the short-term hit. Or there's someone like a Fastenal saying the math doesn't work. We have to raise prices. Someone like a Five Below, this value discount store, saying that they're just not getting anything from China. They're pausing all shipments. Or some of the European car makers saying we're not going to have exports into the U.S. markets. So if one thing that's important is navigating tariffs, the other thing is guidance. Again, the consistent thing here is no consistency. Delta, Frontier, the airlines we've heard some from so far just have completely done away with their guidance, saying we don't know what it's going to look like, not giving numbers. Or you get a CarMax that says we still have these long-term goals, but we are removing the time frame for which we think we're going to reach them. We also heard from Walmart, which for their part just increased the range of possible estimates. Or you can do the Levi's model, which again, this was an interesting one. They kept their guidance unchanged with a big caveat saying this assumes that nothing changes in the macro or consumer environment. And we're going to assemble a team to try to figure out exactly what tariffs mean. John.
Hey, Danny, thank you. I have to say, I like the Levi's approach. Just say, based on our assumptions, things are going to be okay, but our assumptions haven't changed since the tariff headlines hit.
And guess what? We've got a task force that they'll handle it. And you know what? We're not going to be responsible.
Good luck to them. Sort of finger up in the air, trying to gauge what, which way the wind's going and what the temperature is.
Honestly, I think that a lot of people are going to be saying something similar because guess what? This is your free ride. So that's what people are going to do.
Stuart Kaiser of Citi has this to say. This is a case of tail risk reduced or delayed as opposed to removed. Stuart joins us now for more. As he says, good news is needed. And quick. Stuart, it's good to see you.
How are you? Happy Sunday.
Did we get any of that good news over the weekend?
Yeah, I think we got some of it. I think the 90-day tariff delay and then, try to exempt some of the tech stuff is incremental progress. I think that stuff trims the tail a little bit, but, they quickly walk back, the positive response. If this was a weekday, we probably would have had a 5% rally and then a 3% sell-off. Luckily, we were closed on Saturday, so we didn't get that. It's progress. I mean, it's either an acknowledgement that they had gone too far and are a little bit concerned about, market functioning, or, they're just trying to deliver a little bit of good news. But without a doubt, they've trimmed some of the tail off. It's still a long tail, but I think they've trimmed a little off.
So the word that got thrown around in the past week, negotiation. We're going to negotiate. Are they negotiating with themselves at the moment?
It's a little hard to say. I mean, a lot of trade delegations are supposedly in town and they're talking. It does seem like they negotiated with themselves on the way up and on the way down. China's basically said we're done, with the tit for tat stuff. So it does a little bit feel like they're kind of responding to shadows and to what's going on in markets as opposed to sitting down across the table with someone actually, trimming up numbers.
Well, you say markets, but it seems like they're looking at one market. It's not your market. Do you feel left out? I mean, is there a sense that basically it doesn't matter how much stocks sell off as long as the bond market is stable? That's not going to be a limiting factor for this White House.
Well, we actually got it right this time, I think, Lisa. I mean, I remember a couple of weeks ago you said credit spreads haven't widened, so this equity response is overdone. Equities actually move first. So I would say that we're kind of the winner of the clubhouse, so to speak, on a Masters Day. And, look, without a doubt, I mean, I don't think this is a Trump equity put. If there is a put, it's associated with the credits or the credit or bond markets, full stop. If you look at what happened to credit spreads and implied volatility on HYG or LQD the last couple of weeks, you can see that being very, very aggressively priced. So, yeah, I would agree. I mean, if it's an equity put, it's still quite a bit lower than here, I would say.
But, Bob, do you get the sense right now that the bond market truly is king? And if there is some sort of bid into the bond market, that could free up to more policy uncertainty? Because essentially, if that's the only thing that matters, well, if it's calm, let's go.
First, thanks, Stu, for dragging us out with you down into the swamp. Credit was doing great. It was holding in. Corporate profitability looked okay, and there went the equity market, and credit spreads had to widen. I think for us, when we look at how businesses are going to respond to the environment, one of the things we're looking at is when you get through the quiet period, forget about what they're saying about hiring and labor. Are they actually going to be back in buying their shares? And does that create some sort of support? If that does, then the bond market will follow. Certainly credit spreads will come in.
Stu, what do you think?
I think that's right. I mean, Broadcom last week announced a pretty sizable buyback. You guys went through, case by case.
Yeah.
You may say I want to go the Levi's approach. I would say look at the Levi's stock price that day and tell me if you still want to, do that approach. It was pretty tough. So look, it's like we've talked about this multiple times. If you're going to kind of kitchen sink it, you're probably going to have a buyback or something announced alongside that, to kind of underwrite it a little bit. I do think if you say we're good, you better have a lot of evidence. And if you just pull guidance, I don't think that's the right way to go right now.
What do you think of the approach of the banks so far? We get more bank earnings through the week. We've heard from several players on Friday. What do you make of their approach?
Look, I think bank earnings, and look, it's very early, but kind of largely as expected. You're in a volatile environment, so the trading stuff looks good. M&A pipeline has been kind of kinked, so you're not going to see a lot of response there. And obviously, like private wealth AUM in a declining equity environment is going to look a little lower. So I think the results are as you would have expected. They're clearly going to have to signal some caution on the loan side of things because it'd be kind of irresponsible for them not to. So it feels like they're kind of managing things, about how you would expect.
So it sounds like earnings matter for everything except for tech. And I do wonder at this point if U.S. tech is not uninvestable, but just a lot more difficult to invest in given the fact that there's been so much volatility. They are a beta trade, and they also are facing potentially a special focus type of tariff to make sure those products get reshored, whatever that means, according to Howard Lutnick this weekend.
Yeah, I mean, it's tech earnings are vital, obviously. I think the risk coming into the year, the risk was tech is very expensive and it's extremely overowned. I think you would probably say it's not quite as expensive and not quite as overowned as it was, but there are clearly acute risks to the earnings side depending on how the tariffs go. I was surprised NASDAQ isn't up a little bit more, at least on the open. So that's a little bit troubling, perhaps. But look, if you saw last week when the good news came out, what worked? Tech stocks bounced. Growth stocks bounced. I think the ability to get into those stocks at a lower valuation is enticing people. And also, what's your other alternative? Like, people do not want to buy cyclicals here because they're really worried that the next leg of downside would come from recession risk. So I think what you're seeing is people are trying to stay in large cap tech and growth right now if they're kind of dipping their toes in. And I don't know that those toes are that dipped in.
How well insulated do you think those tech names are from the cycle, from the international cycle, not just the domestic story here in the United States?
Well, I think the question there is if they are insulated to some degree, do you get a knock-on effect into CapEx and into buybacks, right? Like if you look at buybacks historically, for instance, you buy back more when you're earning more. Right? So if you're earning less, you're probably going to be buying back less. There's a lot riding on CapEx guidance from 3 or 4 of these big stocks. If you're a little bit worried about earnings and foreign demand, do you pull back on that CapEx? And I think those would be your two biggest concerns going into tech earnings, would be from those two sources. How do they view their earnings profile going forward? How much does that impact their intent to spend both on CapEx and buybacks related to that?
I'm glad that you brought up, John, the cycle, because right now, this is really the ultimate question. How much is the cycle going to get accelerated to the downside on a global basis when you have essentially a lot of pressure from the tariff and the trade war around the world? And I just wonder at what point we could see that. And Bob, we're going to get a host of data this week, like retail sales. Does it start to matter at that point to get a sense of where we are in the cycle?
I think it does. I think what is going to be interesting is to see if consumers hit a pothole, if they have pulled back on spending, if they feel that things are uncertain, if they feel that prices are going to reset so much higher, they just want to stop and save. If they have equity exposure, maybe through their retirement plan, and they see that's been reset lower, it's not the kind of environment that you want to go out and spend. I keep going back to, when you look at tariffs, it's taxes on businesses and households. And I don't remember an economy that taxed its way to prosperity.
Neil Dutcher of Renmac just writes in. Neil, thanks for watching. Says the following. I feel like we're at the limit of how much Trump can escalate. That part of this is over. As the Chinese have rightfully said, it's a joke at this point.
Well, that has been the feeling. The question is whether the escalation takes another form, because we did see, for example, China putting some limits on some of the rare earths metals. Over the weekend, they said this is a good first step. Let's see if they still think so, given some of the other things. And then it's less bad because you're taking the tail risk out. But if you have this level of escalation for a long time, does it take on a different type of contour in the economy?
Stuart, just a final word here. You've taken a conservative approach to trading over the past number of months, waiting for that data to break. And I remember you saying that repeatedly over the last few months. What's the approach now into this week, into things like retail sales?
Look, I mean, our view is kind of the risks in the near term are probably tilted a little bit to the upside, because if you're going to get good news from negotiations, I think that has to happen in the next 2 to 4 weeks. And if you don't get good news on negotiation by then to Lisa's point, you have to start pricing downside risk to the economy via recession. So excuse me, if you want to get bullish, I think it's actually kind of a tactical trade. If we're sitting here 6 or 8 weeks from now and they're still like diddling around with negotiations, I think you're going to see numbers significantly lower. Scott Kroner on our side, cut his EPS number to 255 for the S&P from 270. And I think you would argue that that's probably pricing in tariffs alone, not really a full recession. So when does the data crack? Who knows? Yeah. Mish on Friday was certainly not encouraging to see sentiment, hit in that way. And so I do think you're going to need to see like real progress in the next 2 to 4 weeks before the market really starts to cut numbers.
The numbers Friday were dreadful. Couldn't agree more. Stuart Kaiser of Citi. Stu, thank you. Good to see you. Bob's going to stick with us. Let's get you an update on stories elsewhere this evening with your Bloomberg brief. Let's cross back over to Danny Berger. Hey, Danny.
Hey, John. The Trump administration has exempted smartphones and other electronics from its so-called reciprocal tariffs this past Friday, a major reprieve for global tech manufacturers like Apple and Nvidia. However, officials say that they are still subject to a 20% levy on China related to fentanyl. However, this morning, Commerce Secretary Howard Lutnick said that those tariff exemptions will be temporary. He said the administration is creating a new set of tariffs targeting popular consumer electronics and hopes to announce them in the next month or two. Meanwhile, President Trump doubled down on coming tech tariffs in a Truth Social post this afternoon. Elsewhere, Minneapolis Fed President Neil Kashkari has ruled out a rate cut as an insurance policy against an economic slowdown, saying the priority is inflation as the labor market looks strong. Kashkari expressed confidence that markets will remain orderly despite trade uncertainty. And that's your Bloomberg brief. John.
Danny, thank you. Fed officials, Bramo, not blinking here, not blinking at all.
Yeah, I mean, some people are trying to hang their hat on Susan Collins, but other than that, pretty much they're like, look, this market's functioning. It doesn't like things. It's volatile, but volatility is not breaking, so we see no problem. Good luck.
What do the kids say? Not my monkey, not my circus. Seems to be the approach over the last week.
100%.
The last week
not
or
my
so.
bag, baby.
Equity futures this evening positive by 0.7%. Up next on the programme, some final thoughts heading into a brand new trading week. Live from New York. You're watching Bloomberg TV. If you are just tuning in, welcome to the programme. We are live, of course, on a Sunday evening once again. Looking for better news this evening. Equity futures are positive by 0.6% with a deeper look at the markets. Let's cross back over to Danny Berger for more. Hey, Danny.
Hey, John. We've also had FX markets trading for about the past 4 hours. And if you're hoping for a reprieve, or at least a decisive reprieve for the dollar, maybe shut your screen off and hope for something better tomorrow morning. You're looking at a euro, which is weaker versus the dollar, but it has started to peter out. When the currency markets first opened, the euro was weaker versus the dollar about 0.75%. But as you got that Truth Social post for Donald Trump, the dollar then again started to lose steam. It's that ominous link between risk assets selling off and a weaker dollar that seems like it might persist into next week. Speaking of risk assets, just a quick look at some other commodity markets. This evening, you are looking at oil, which opened higher, again, unable to sustain onto those gains. We're not really seeing anything convincing in markets. Both WTI and Brent down about 1/3%. Gold, of course, this hit an all-time new high. It still is holding about 3,200, but that's also lower by about 0.5%. John.
Hey, Danny, thank you. The most exhausting rally ever in a past week. Just think about what we delivered. A gain of almost 6% on the S&P 500. If you ask someone what equities did over the last week, do you think they'd come up with that? The best week of the year? I don't think so.
I don't think it felt like the best week of the year, and I don't think anyone has confidence that it's going to stick. That said, there is this feeling that we have gained a lot back. If you said that we had all-time highs just a couple of weeks ago, I also wouldn't believe you. It feels like such a roller coaster, and people are exhausted.
The all-time high on February 19th feels like a lifetime ago, right?
It was a lifetime ago.
The moves we've seen in the bond market since just this week, 50 basis point moves on a 10 and a 30. and the dollar was weaker, not stronger. A lot to figure out in the week to come, and your week to come looks like this. So here's the calendar. On Monday, earnings from Goldman. On Tuesday, more earnings from Citi, Bank of America and United Airlines. On Wednesday, US retail sales and comments from the Fed Chair Jay Powell. Look out for that. Thursday, an ECB rate decision and another round of jobless claims before wrapping up the trading week early for the Good Friday holiday. Let's head down to Washington, D.C. and catch up with Tyler Kendall in the nation's capital. Tyler, let's wrap up the weekend and think about what's still to come this week. What are you and the team looking for in the days to come?
Yeah, hey, John. Well, we could get a better sense on how negotiations are going when it comes to the tariffs on Thursday. The Italian Prime Minister will be here at the White House as the European Union in particular tries to find a path forward here when it comes to negotiations, considering that all those countries were tariffed as a bloc. Now, people familiar do tell Bloomberg News that Italian Prime Minister Meloni will propose to President Trump eliminating all tariffs on bilateral trade between the EU and the U.S., something actually Elon Musk had floated earlier this month, but it really remains to be seen if that's something that this White House would seriously entertain, or what sort of concessions they would need to entertain it. Of course, we hear a lot about those non-tariff barriers like the VAT and digital services taxes, which Italy does have. So we'll try to see if we can glean any details, particularly when it comes to the European Union next week, because, John, as you know, they were supposed to put into retaliatory impacts this week, but ended up holding off on that reprieve once this White House put into effect that 90-day pause.
Tyler, before you go, when can we change the conversation from tariffs to taxes? How quickly can we achieve that?
Right, so that's one of the big questions here. Of course, both the House and the Senate ended up going on recess on Friday after they had passed that critical Senate budget blueprint through the House chamber. But there's still some big questions here, and trust me, lawmakers are going to hear a lot from their constituents, particularly when it comes to spending cuts over the next 2 weeks, and that could potentially impact the conversation going forward because, as you know, the Senate ended up passing $4 billion in spending cuts. The House plan wanted $2 trillion. They ended up coming together on the pledge from Mike Johnson that there will be $1.5 trillion in spending cuts, but that is raising questions about what that will mean about the future of benefit programs like Medicaid. Lawmakers are going to need to come together to figure that out. The House wants to get their version passed by May. As of now, that seems pretty ambitious, but we'll have to see as President Trump ramps up the pressure because this White House wants to get cash into consumers' pockets and quickly because this is all linked to that tax cut agenda.
Tyler, thank you. Great work. We'll see you early tomorrow morning. Thank you very much. For some final thoughts around the table this evening, JPMorgan's Bob Michael. Bob, let's wrap it up. How will you and the team approach the coming week?
Well, when I left last Sunday, I was extremely concerned about what the week held, and that proved to be right. When I leave tonight, I feel much more optimistic. I feel that we're in a market that's going to be stable. I expect Treasury yields to be stable and actually drift a bit lower. I think a lot of the deleveraging has occurred. When I listen to Stu, I think he's right. I think we're in the negotiation phase of the tariffs, and that will be pretty positive for the next couple of weeks. I need the equity market to do better for credit spreads to do better. I think that's going to happen. And when I think about our client base, I think about the pension fund and insurance companies that have been looking for a 5% 30-year and wider credit spreads to get into this market. They're going to have it. So I think this week will be one of stability.
This week of stability, does it depend at all on any of the granular data we get out, whether it's retail sales, whether it's the earnings? Will this market respond to those things, or is it focused squarely on the White House and what we hear there?
I think the data will be overwhelmed by what's going on with the trade negotiations. So if there's good news that comes out of that, people will dismiss the data. If there isn't good news that comes out of that, and if we hear more noise out of the administration about ever higher tariff levels on all the things that haven't been addressed yet, then the market's not going to like that.
What do you think changed the story from when we all last spoke? What changed it? Was it the bond market? What was it?
I think the insane amount of volatility in trading. I think the deleveraging that we know occurred throughout the bond market, the things that didn't make sense unless they were deleveraging trades. And then I think the administration coming in and putting in place 90 days of negotiation.
Their response to that, does that give you confidence that you know there is a pain threshold and you can identify where it actually is?
It does give me some level of confidence. And there are many other pieces of the puzzle. Talking to our non-U.S. clients and seeing that they are structural holders of U.S. debt, and they're going to remain structural holders of U.S. debt. All of those are positive things. and dismiss the narratives that were created out there that have no basis.
There was a quote out on X, and thank you, Hank MF Reardon. You are a king until the bond market takes your scepter. And this was the feeling in markets this week. And the reason why some people are saying that we do have some certainty now is that there is some response to some market pain that this Trump administration will listen to. Is there a level of certainty that we have today that we did not have last Sunday when we sat here, waited for futures to open, saw them open, wanted to shut our computers and go home?
Well, it is true that funding pressures on not only businesses and households, but also governments can bring people to the bargaining table pretty quickly. So that is true. I agree with the writer of that. Do I think that things are stable and have been resolved? I think they're stable. No, they haven't been resolved. We'll know that over the course of this month.
Bond vigilantes aren't a new concept. What's new is to see this in the Treasury market. Lisa, I think that's what's surprising us, something you've talked about for months and months, if not years, waiting for that moment, that maybe that moment would develop in the Treasury market. And to some extent, I think you can make the argument it has. To Bob's point, though, this week's been a really interesting one. So you've had the price move and people have attached to it a theory, a narrative that international investors are moving away from dollar-denominated assets, that it's threatening the safe haven status, that Treasury markets will no longer provide what we call on this programme those risk mitigation characteristics. How much longer do you need to really get that definitive answer? Have you had it already? How much longer do other people need to get that final answer on that? Because those are the kind of things that don't happen overnight. They take weeks, months, years, and sometimes they take decades.
I think we've seen enough. I think the Fed report on Friday showing that there were actual net foreign buyers of Treasury securities is one answer to that. I think if that changes down the road, yeah, then I might change my view. But right now, I don't see an alternate reserve currency to the US dollar. I don't see an alternate safe haven asset to US Treasuries. I can understand the price movements, and actually where we are on 10-year Treasuries is about the average yield since the start of the year. So there's been a lot of volatility around that, but we've moved a lot and really gone nowhere.
You said a couple of months ago, or maybe it was less, that you could see this whole yield curve in the U.S. be below 3%, maybe even by the end of this year. Do you still believe that?
No, I do. I think I'm going first off with the Fed telling us before all of this, their neutral rate was 3%. I'm going with our probability of recession is still above 60%. And our expectation is that businesses and households do retrench and do some saving. And I'm going off of a belief that the Fed is talking tough now, but when unemployment goes up, they're going to step in and bring down rates a lot. And I think 3% isn't the floor of where they're going. I think that could be the ceiling. We'll see what other policy responses there are.
Bob, it's good to see you, as always. Thanks for doing this again. We appreciate your time. Thank you. Bob Michael at JPMorgan Asset Management. Language is important. Bob said when unemployment goes up. And there's a feeling it's when and not if at the moment.
If it goes up, though, later in the year, does the Fed have the air cover to respond, to quote Mohammed El-Arian? But this is the feeling right now, consensus across the street as they ratchet down their expectations.
See you tomorrow morning.
I guess so.
Sleep here, Bramo. Get comfortable.
I think, this is going to be great. We'll sleep under the table. Look, ultimately, this is going to be a tumultuous period.
Yep.
People are exhausted.